Alright guys, so we know that tax season is approaching and we are in the last quarter of 2025. If you are in Canada, we will be talking about the top 5 things. There are actually many more than that, but today we will be talking about the top 5 things that you should be considering in terms of your tax moves that can help you allocate, save, plan better for the tax season that is coming up. And if you guys are not aware about it, for the personal side, today we're going to focus on the personal side only, not on the corporation side. So on the personal side, we will be talking about these top 5 tax moves that Canadians should take that can just help you plan better for your taxes. So we'll be talking about the capital gains planning, FHSA contribution timings. The third one would be TFSA and RRSP optimizations, charitable givings, and the last one would be salary versus dividends for business owners. So if you are, let's say, running your one-man show, or if you run a corporation, you're not sure how to plan for your salaries and dividends, we will be talking about that as well. So now, first things first, capital gains planning. Capital gains, what is capital gains is anytime you hold any investments, any assets, whenever you sell it, that triggers a capital gains as well, and on those capital gains you have to pay taxes. Let's first understand how your capital gains are taxed. Let's take an example of any investment. For example, you can imagine that could be a crypto, that could be anything else as well. Let's just say you had $10,000 invested, and in this year it grew up to, so let's say this was your cost base, and your fair market value is somewhere $50,000. Again, we are just taking these numbers for example purposes only. So now if it's $50,000, you have $40,000 as your capital gains. If it was invested through your TFSA account, that is your tax-free savings account, there would not be any taxes on it. But if it was invested into, let's say, crypto assets, many of the people are getting into crypto these days, or it could be your non-registered account as well. If you have your assets, or that could be properties that you hold, whatever it could be, any taxable assets. On this $40,000 of capital gains, 50% of it would be tax-free, so which comes down to 20,000, and 50% of it would be taxable. This portion is tax-free, you do not have to worry about it. But now how to plan for this other $20,000? That is exactly what we are going to talk about, is the capital gains planning. So you have this taxable capital gain of $20,000. Let's see how to plan for it. Karan, is there any way I can do planning? Of course, yes. Let's just take an example here. It will be easier to understand via example. If let's say I am earning some amount from my employment income, from my business income, whatever it could be. Let's just take an example, and please keep this number in mind of $20,000. So keep this number in mind of $20,000. Let me write it here. So 20,000 is your capital gains. How to plan for it? Example is, if let's say my taxable income for this year, that is 2025, is, let's just say, $60,000. That is the average employment income here in British Columbia or in Ontario. So let's just say my taxable income is this year is $60,000. I know that next year I will be getting into a better job. I will be, let's say, having another business that I'm planning to run. Let's just say I know in my 2026, my taxable income would grow from $60,000 to $120,000. That would automatically increase my tax bracket as well. But I do have this capital gains. So if I know, hey, I'm planning to hold it, or I'm planning to, let's say, sell it in maybe February, or let's say I am planning to mature these investments in March or April, whenever it could be, I'm planning to do it in next year. But I know if I do all the amount in my next year, I will be in very high income tax bracket of $120,000. So what I need to do here is I can sell this in this year, in current year. That way I will be adding $20,000 into my $60,000 of taxable income. Now, if we look at the net effect, so there we will be adding capital gains. That would be $20,000. Here I will be paying my personal taxes based on my $80,000 of income in total. But if I waited for next year, I would have been, I would have paid my personal taxes on $140,000. Of course, my tax bracket increased. Not only that, but my taxable income also increased. So I would end up paying a lot in taxes. So this is where your planning would come in, that you need to understand when should I sell it, considering if it's a short-term planning or if it's, let's say, a medium-term planning. For example, if I was planning to purchase a house in next year, maybe I have all the assets in my non-registered account. I'm saving my money into crypto assets, into my stocks, bonds, ETFs, wherever it could be. I know I will be maturing everything in next year, but in next year, I'm also planning to open up another business, or maybe I'm planning to have a side gig as well, or maybe I'm expecting a huge promotion next year. Whole point is next year my income would be high. So I need to make sure I sell those assets today. Now, Karan, if I sell those assets today, my assets will stop growing for next year. Not true. Well, true and not true. There is a strategy that is called tax loss harvesting. What exactly is tax loss harvesting? This strategy simply means that when you know that in 1 year I'm going to have a capital losses instead of gains, or if I know that, and this, it's not only tax loss strategy, you can utilize this capital gains harvesting as well in your profits and in your losses as well. So the whole point of it is, if let's say I know that in my this year I will be having capital gains, but my next year my income will be higher. I need to make sure I pay taxes on my this current year's capital gains or my this current year's taxable income. What tax loss harvesting means is, if let's say, what if there was $20,000 of loss instead of gain? What if it was a loss instead of a gain? Now, in this case, what you would do is you can, in this year, it would be reversed now. Situations would be reversed. So, what if in this year your income was high and next year your income would have been lower? Or doesn't matter. You simply want to make sure you utilize your some losses in this year. What tax loss harvesting, and there are some rules and regulations to it as well. So if you are wanting to adapt this tax loss harvesting strategy, it is very sensitive. So it simply means if you have any losses in your investments, you can sell those assets in this year, claim that loss in your current taxable income. So that would make sure it reduces your taxable income. You're paying less taxes or you're reducing your tax liability. So if it's a refund, government will give you a refund, more refund. If it was a payable, it will reduce your tax payable. So you're claiming your capital gains in your loss in your crypto assets, those losses in your taxes. And this year, due to tariffs, due to all the other stuff that was happening in the market, many of the people have faced losses in their investments. So all you could do is sell those assets, claim that loss in this year, and if you want to purchase the similar assets in, let's say, if you're planning to do this, hey, I sell my assets on December 31st, I purchase those same assets in January 1st because I know in the long term they're going to come back, you cannot do that. In tax loss harvesting, there is something called superficial period. That superficial period is of 31 days. This 31 days period simply says that if you are selling anything in whatever year, you have to, if you're working on the tax loss harvesting strategy, you have to wait for 31 days to purchase the similar assets or to purchase the exact same asset or even the identical assets. So you have to wait for 31 days period. So this is where if you are an active investor, if you are an active trader, whosoever you are, you need to be very careful here that would it make sense for you to wait those 30 days and make sure you take those losses, wait for 30 days, or you can even make minor changes in your portfolio and you can still get into those funds, maybe a different set of portfolio. It could be same if you're into equities, it could be equities, whatever it could be, but you need to make sure you claim that loss, you wait for 31 days if you want to get into exact same stocks or bonds, and then you can purchase the same thing. Whenever down the road, when you get profits, you can of course sell it. So there is a planning involved depending on two things. Number one, is your income gonna be less or high in the next year? And number two is your are your assets having losses or profits in this year? These are the two things. Depending on that, make sure you plan your taxes accordingly. You have about 3 months to plan for it. You plan it right and make sure you save some money on your taxation. It all comes down to planning. No one plans to fail, everyone simply fails to plan. So if you want any personal advice, feel free to reach out, but this is something you need to be careful about. Second point. So second point comes down to your FHSA contribution timing. Before we get into contribution timing, let's understand what an FHSA is and let's understand what the contribution limits are. So if I talk about both the things, FHSA is one of the best accounts for someone who is planning to buy their house in next 15 years. The reason I said 15 years is because your FHSA can stay open up to next 15 years. As of today, those are the rules unless government changes it. So as of now, if you open up an FHSA, it stays open for 15 years. Question comes in, Karan, what if I do not want to purchase a house? Second question is, what happens after 15 years? Answer to both of these is you can transfer your FHSA amount into your RRSP and you need to, and there won't be any taxes for that. On top of that, your RRSP room would not be affected by whatever money you bring from your FHSA. So there is no contribution limit that will be affected. So it's a very beautiful thing. If you end up buying a house, amazing. How FHSA works if you are buying a house. So we talked about if you are not buying a house, it still can make sense. But what if you are dicey about it? You are not sure if you want to buy a house. If let's say you're planning to buy a house in FHSA, every year you can contribute $8,000. Okay, up to $8,000 is what you can contribute. This amount could also go up to the maximum of $16,000. How? We will come to that in just about a second. But by default, every year your annual limit is $8,000 and your lifetime limit is $40,000. So this is your annual limit and that is your lifetime limit. You cannot contribute over $40,000. Now, how would that $8,000 that you contributed into FHSA, how would that work? Let's take the same example. If your income is $60,000, any money that you contribute into FHSA, it would reduce your taxable income. So now your taxable income is $52,000. What end up happening here? Let's say on this $60,000, your tax that you paid was, I'm taking very rough numbers here. Let's say the tax that you paid was $10,000, but on 52,000 you should have paid $8,000. Whatever the difference is, roughly $2,000, that is your refund back from the government. So you're getting that tax refund back from the government. Now, how can you increase that contribution limit up to $16,000? FHSA contribution limit is very different as compared to tax-free savings account or your registered retirement savings account. RRSPs, registered retirement savings plans, those contribution limits start when you are earning. TFSA starts the day you either became 18 or 19 depending on your province, and then at the moment you are tax resident of Canada. But for FHSA, the contribution limit starts only when you open the account. Let's say I did not open the account in 2024. I cannot contribute $16,000. So my contribution limit would not carry forward. But if I opened my account in 2024, I did not contribute anything, that contribution limit will be carried forward into the 2025 year. But I need to tell CRA when I filed my 2024 taxes, I am supposed to tell CRA that, hey, Mr. or Mrs. CRA, I opened up the FHSA. There is another schedule for it when you file your taxes that, hey, I did open the FHSA account, but I'm not contributing anything. So they would allow you to carry forward that. If you did not tell CRA, next year they are not going to allow you any contributions done over $8,000. So you need to tell them beforehand. Doesn't matter you contributed or no. So you can carry forward your FHSA limit only up to 1 year maximum. So if you opened your account in 2024, in 2025, you can contribute $16,000 and that is something that you can deduct. What if you contributed 16,000, but again, coming back to the same scenario, but what if you know that in 2026, your income would be higher, but you already contributed $16,000? And what you could do is, even if you contributed $16,000, so CRA is definitely fair sometimes, even though we do not like taxes. Even if you contributed $16,000, you have option of claiming. You claimed only $8,000 or more or less, you have the capacity to carry forward extra $8,000 to your next year. So you can carry it forward if you know that next year your income would be higher. So guys, it definitely comes down to planning. Again, no one fails to plan, everyone plans. No one plans to fail, everyone fails to plan, right? So you need to make sure that whatever your FHSA contribution timings are, and one very big thing, let me put this as a scenario and let me know if you guys know the answer to it. Let me ask this example. So there is a case study. Let's do a case study here. If let's say I signed a contract on a pre-sale property. Say I signed a contract in August 2024. I signed the contract and my completion is in April 2025. When I did the deposit, when I signed the contract, I made a deposit. I withdrew from my FHSA and I made the deposit. Can I still contribute into FHSA in the year of 2025 because my completion is in April 2025? Anyone knows the answer to it? I purchased a pre-sale property. In August, I made the deposit, the down payment while withdrawing from my FHSA. My completion is in April 2025. Can I still make contribution in the FHSA account for the year of 2025 because my completion is in 2025? So the requirement says that when you are contributing into FHSA, you should not be owning a principal residence. You should not be residing in a principal residence. And we will come to another situation as well where what if you already have a house, can you still qualify as a first-time home buyer? We would come to that as well. But the requirement says when you contribute into FHSA, yourself or your spouse should not be owning a principal residence. So if my completion is in next year April, can I still contribute into FHSA? The answer is no. If I already made a qualifying withdrawal in 2024 when I made the deposit, I already made a qualifying withdrawal. Once I made a qualifying withdrawal, anything that I contribute additional in FHSA is not allowed as a tax deduction after my qualifying withdrawal has already been made. Doesn't matter if you already have the contribution limit or no. So this is where a lot of times, if you are into financial sector, if you are planning to buy a house, do not make your down payments deposit, or do not make that deposit from your FHSA if you're planning to utilize FHSA for next year as well. I hope that helps. So be careful here as well, because one of my client, he is closing his property next year April, and this is a real case study. He is closing his property next year in April, but they would not be able to use their 2025 contribution limit, and it's a couple. So yourself and your spouse, $16,000 of tax deductions is something that you missed out on. And if you're in the 30% tax bracket, that is roughly about $4,000 to $5,000, right? So you never want to miss out on anything that gets you can get back from the government in the legal ways and the ethical ways. So be very careful how you're planning your FHSA. Now another question: if someone already owned a house, can they still qualify as a first time home buyer? The answer is yes, but what is the condition? If yourself or your spouse owned a place and you have not lived in that property for 4 consecutive years, then yes, you qualify as a first time home buyer. If I purchased an investment property but I'm living with my parents, I have not lived in that property for 4 years, yes, I still qualify as a first time home buyer after the fourth year. I hope that helps. Any questions? Feel free to ask. Moving on to the third part, the TFSA and RRSP optimization. Many times I get this question, Karan, should I contribute into TFSA? Should I invest through RRSPs? And one thing, whatever these tools are, guys, these tools are just the baskets. And if you're not having some good fruits in your baskets, that basket is of no good. Now, let's understand what a tax-free savings account and what an RRSP is. Very basics. So your tax-free savings account, anything that you deposit in your tax-free savings account does not give you any tax deductions. But any money that grows in this account, and many times people say, Karan, I have TFSA, but there is no interest in TFSA. It does not matter if you have TFSA or no. Your growth would matter what kind of investments you have in your TFSA. Same thing with your RRSPs, same thing with your FHSAs. Yes, they do have their own original pros and cons of how it's designed, but again, if you want if you want growth on your money, it has to be invested. That could be high interest savings account, GICs, stocks, bonds, whatever you can name it, whatever you can find good for yourself, depending on your investor profile. So that is what a TFSA is. And then the RRSP, how RRSP works is any money that you contribute into registered retirement savings plan, it gives you tax write-offs just like first home savings account. But keep one thing in mind, when you have to withdraw that money during the time of your retirement or whenever you want to, and I'm going to give you guys a very amazing strategy right after this. So when you have, let's say, an RRSP, you have to withdraw from your RRSP, it is considered 100% taxable income, just like as if you earned that income from your employment. Now, would it make sense? How it would make sense? For which person would it make sense to get into RRSP? Let's look into it. Your TFSA would make sense if you will be in, if at the time of retirement, and let's say today. Okay, so this is today and that's your retirement. Let's look at the tax brackets. So if your tax today is high and at the retirement it would be low. For this case, what would be best is RRSP. But if your tax is low today and at the time of retirement you will be in the high income tax bracket, then TFSA would be best for you. It's as simple as that. Any questions in this? Feel free to ask. So how this would work is today I am in 20% tax bracket. So I would keep investing in, let's say, TFSA account, and because I know at the time of retirement I will be in very high tax bracket, let's say 50% tax bracket, because I will be having rental incomes coming in, I will be having some corporations income coming in, I will be having some dividends, money invested here and there. I know I will be super wealthy at the time of retirement. So I need to make sure I keep investing not too much into RRSP, but yes, in TFSA. I need to max out TFSA first. But if I am earning $150,000, $200,000 today, I am in very high income tax bracket as of today. So I need to make sure I invest into RRSP today, because at the time of retirement, I will be in the low income tax bracket. There are some strategies and that you can make sure. But make sure whatever you are choosing, TFSA, RRSP, FHSA, make sure your money is invested as well. Talk to some professionals, do your own research as well, make some informed decisions. Now, let's take a scenario. And by the way, do you guys know, let me pull up an example here. Do you guys know that in Canada, if there is one person, let's say a couple, they both are earning $100,000 each, and then there is another person who earns $200,000, and let's say wife is a homemaker. Do you know that these guys will pay less tax as compared to this couple? Very unfair, right? That is true. So what this person could do is, let's see what this person could do. And the reason for that is because that is how Canadians' marginal tax rate works. So what this person could do, if you have $200,000 and if your spouse is not earning any money, and it could be either or. Well, these days females are making some really good money as well. So what if this person is making $200,000, another person is not making any money? This person can invest in something called spousal RRSP. How spousal RRSP would make sense? If you contribute into spousal RRSP, this person is in the 50% tax bracket. So how much is the tax deduction that this person would get? Let's say 50%. Take an example here. If I invest $50,000 into spousal RRSP, my tax refund is almost $25,000. Who doesn't want this $25,000 of tax refund, right? So my tax refund is straight away $25,000 that I'm getting back from the government. Now, is my money locked until retirement? By default, yes. But this is where spousal RRSP would play a big role. There is a 3-year, you can call it a waiting period. Your spouse would have to wait for 3 years, but after 3 years, your spouse can start withdrawing the money from the spousal RRSP. Let's say I end up investing $50,000 for 3 years, there is $150,000 sitting there. If my spouse starts withdrawing only $25,000 per year, she is still falling under like low taxes, and even if we end up paying, let's say 10% taxes, so that is roughly what, $2,500. If I keep doing the same thing, I would make sure that I paid very less taxes after. So my spouse paid very less taxes, but I ended up getting $25,000 in the form of tax refunds. So this is where again planning comes in. TFSA versus RRSPs. So there is a planning involved. Make sure you sit down, make sure you plan for your finances right, make sure you plan for your taxation right. If we do not do this, when it comes down to tax paying, we would have only one thing to do. We would be blaming the government for the taxes. And it's not that they're going to do anything. We would simply end up wasting our energy. So it's much better to understand the game and play by the rules. Let's go for the fourth point, charitable giving. This is double. Has anyone heard about a term called double taxation? Well, government is usually fair, so CRA has set some rules accordingly where you do not get stuck into double taxation. But let me tell you this, there is a way where you can get double benefit through charitable giving. Now, that double benefit does not mean that I'm getting benefit. Oh, one could be my taxes and second could be having a good name in the society. No, these are not two benefits. I'm talking about the double benefit only in the taxation. So you get double benefit in the taxation. This is an amazing point. How it works, depending on your province to province, if let's say you invested or if let's say you donated $1,000, on roughly $300 would be your tax refund, or it would reduce your tax liability if it's a payable, depending on your province to province, right? Now, here, if this is, you would have simply paid it from your hard-earned money. Yes, you would have gotten 300 back from it, $1,000 of donation receipt. You had a good name in the society. But instead of just giving cash, what if you donated investments? How can I do that? And can I even do that? Yes, you can. Instead of this $1,000 of cash, what if I donate $1,000 of investments? On my investments, when I purchased those, let's say $500 was my cost base, and today's fair market value is $1,000. I donated at $1,000. So I will be getting the tax refund back on the $1,000. But do not forget, if you donated cash instead of investments, you would have paid capital gains on your $500 of capital gains as well. You would have paid taxes on these capital gains as well. So what you are doing here is you are not only saving your taxes on your capital gains, but you're also taking the tax refund on the full fair market value. So you're much better off to not let your money sit in your checkings account or your savings account, but actually have it being invested. And if at the year end, before the year end, if you were to make any donations instead of cash, you can always make it in the form of investments as well, and it would give you double benefit on the taxation. You're not going to pay any taxes on your growth, plus you're also going to make sure you get the full tax refund as well. Last point, salary versus dividends. This is the last point, guys. If you are a business owner, that should I take out salary, should I take out dividends? First, let's understand how the tax treatment is on the base level for the salaries first. So on the salaries, it is considered as an expense for the company. It is considered as an expense for the company. What it means is, we are not going into corporations taxes in this video, but if your corporation is earning active income, your taxes are 12% on it. If your corporation made $100,000, you took out salary of $50,000, your corporation would pay taxes on $50,000. Make sense? So this is what is considered as an expense for your corporation. So your salary is an expense for your corporation. On the other hand, how are dividends treated? Let's look at the dividends. And we will also come to that, what would make sense in your situation. How dividends are considered, they come from the retained earnings. What are retained earnings? Retained earnings, something that is left in your corporation, something you retain in your corporation after paying everything, after paying taxes. So I did $100,000 of income, my corporation, I would pay 11% tax rate here. So that is how much? Roughly, let's say $11,000. And then I can declare the dividends. So after taxes, let's say my retained earnings are roughly, let's say $90,000. Now out of this, I will be declaring $50,000 in the form of dividends. You may think that here we end up paying more taxes because that $50,000 could have been expense for my company. Yes and no. Government, to prevent double taxation, how the dividends taxes work and the salaries taxes work is you end up paying roughly 11-12% less on your personal side in the dividends as compared to something on these that you would have paid on the salaries. Okay, so because you already paid that 11-12% taxes more in your corporation, that's how it gets adjusted when you put in the dividend income in your taxes. So that is why there is a T4 slip for the employment income for the salaries and T5 slip for your dividends. So that is where the difference comes in. How to plan for it and why there is a need of planning. First things, some people may simply think dividends are less taxes. Their accountant may say dividends is less taxes, go simply declare dividends. As I told you, to prevent double taxation, CRA has set dividend taxation is different than personal taxation or salary taxation. So your net impact would be same if you're declaring dividends or salaries, okay? Unless we are talking about higher numbers, that's a separate story. But for majority of the people, those who we stay in the average income brackets, that your net effect would be very much similar. The only difference would be in the dividends, there is no CPP portion that you pay. And one other thing, there is no RRSP room that you get. So if you are planning, to focus on your retirement savings, then you need to make sure you declare salaries instead of dividends. Because if you want to have RRSP contribution room, you need to make sure you claim salaries and not the taxation. Not the dividends. Sometimes your accountant may say declare dividends, and the reason for that is there is not very hard reporting required for the dividends, unless it's a capital dividend account. That's a separate story. But for your employment income, you are supposed to do your payroll deductions. You are supposed to pay the employee portion, employer portions before a certain deadline. You are supposed to file your T4s before Feb 28th, right? But for dividends, there is no hard and fast rule. As long as your books matches on the personal and on the corporation side, you're good. And I have seen cases where sometimes people do not even file T5 slips, which is not recommended at all. But you need to see what is your long-term goal. If your long-term goal is about the having retirement planning done, definitely salaries is a way to go. If that is not the case, you want very easy reporting, you do not care about the retirement, then dividends is something that you might consider down the road. Any questions or anything until now? So long story short, these are the 5 points. Let's do a very quick recap on all these 5 points. Let's go all the way up. So we discussed about your capital gains planning. Remember the tax loss harvesting strategy as well next to your capital gains planning. Make sure you keep in mind the rules and regulations, and we do not want to trigger any chaos with CRAs. FHSA contribution timings, be very careful on it. When are you planning to buy a house? How can you utilize the best of your money? TFSA RRSPs, we already discussed about what your focus should be. Do not focus on what you're getting today only. Focus on how you're going to utilize those things down the road as well. Charitable giving, amazing tool. Do something good for the society, get the double benefit of your taxation. Salary and dividends versus for the salary versus dividends for the business owners. Any questions, anything, feel free to reach out to me. That's all for today. We will be connecting next Wednesday as well, 6 p.m. Pacific Standard Time, 9 p.m. Eastern Standard Time. Any questions, anything, feel free to ask me. Thank you so much for everyone. Thank you so much for being here, listening to me. I will make sure I keep providing value depending on how you engage, how much you love my content. Any reviews are more than welcome. See you next time. Thank you so much for listening.